God, Jacovie, man, I had to bring you on, man. A lot of people may not know you a musician. I know some people know you a DJ, but yeah, I had to bring you on, man, and get some advice. Some people know you as a DJ. I know you as a sound guy and a DJ. And then I learned from working with you that you are a tax professional, bro. So I think a lot of creatives, entrepreneurs, musicians, we can learn something from you as far as it comes to taxes and things like that, man. So definitely want to bring you on Musical Living TV, bro, so we can talk about that.
Excellent.
Yes, sir, man. So welcome to Musical Living TV, man. Let us know where you from and what you do.
Name's Jacovie Burns from the mean streets of Oak Cliff, Texas, Dallas, Texas in the building. And I do a lot of things, but for the sake of this conversation, we're going to focus on taxes. But like you said, I'm a sound engineer. I have a studio out in Red Oak, Texas, a DJ, and a little real estate investment, a couple other things. But, for the most part, especially this time of year and with all of these crazy changes that are going on, I'm definitely wearing my tax professional hat dang near 24/7.
Nice, man. So go ahead, man. We out the gate right now, man. Tell us, like, as creators, man, what are some things we can do to make sure that we protected for taxes?
Oh, man. Put money aside. A lot of creatives, musicians, artists, just anybody, in the really, I want to say the entertainment field and artistry field. We make cash, or we get paid on 1099s. They rolled out the NECs, the non-employee compensation this year. And, even Uber drivers, it goes on. But put money to the side, because ultimately what I run into with a lot of artist friends of mine, they get to a place where they want to buy houses and the money's there, but the paperwork isn't. And so, there's going to come a time where you have to report some income, some more than others, depending upon what you're trying to do. And having money set to the side, I always advise my artist friends and musicians to say, hey, at least 30% of all the money you make, put that to the side. And just be ready to kind of bite the bullet when you get ready to make those major purchases, like, buying a home, not so much buying a car, but also when you're trying to grow your business. A lot of business loans they need a personal guarantor. So they're going to look at your personal credit as well as your personal income to make sure that even though it's under the business name, you still have the means to support it as an individual. Right.
So when it comes to because you say do 30%, right? Mm-hmm. So how do you recommend doing that? Like if they're getting paid cash, do you say, okay, 30% of $250, I'm gonna put, in a savings account, checking account, what that look like?
Yeah, exactly that. So, I'm not that great at math off the top of my head, but for every $100 you make, take $30 and put it to the side. Whether you keep it in a separate bank account of savings, you might even want to do, say, sometimes they have like those 1 year interest bearing CDs. When you sign up for 1 year, the interest rate might be a little bit higher. Put that money in there so you're making a little bit of interest, but wherever you put it, just make sure you have it ready so that when you file your taxes, we get hit with what's called self-employment income or self-employment taxes. Okay. And basically what that is for a person who's working a W-2 job, clocking in, clocking out, they have Social Security and they have Medicare that comes out of every check. Ain't nothing you can do about it. You never see it, so it's almost easy to forget that it's there. For us musicians and artists, that's what they call self-employment tax, and it bites us at the end of the year. And so that's what you really want to kind of prepare to compensate for, if you're going to try to report a higher amount of income.
Right. Okay. So now, as far as like gas mileage, things like that, the car maintenance, what are your recommendations on like how to keep track of stuff like that?
Okay. There are different apps that you can use. The most important part is the actual mileage itself. What the IRS wants to see is what's your starting odometer, what's your ending odometer, what's your starting location, and what's your ending location. and was it business, personal, or commuting miles? So a lot of times, from what I've seen, the IRS, say a church musician, you go to the same church every Sunday, you know, same place. It might be Sundays, Wednesdays, sometimes Saturdays. And even as an independent contractor, the IRS, they try to say that that's just commuting miles. That's your back and forth. What's important to denote in those instances is the time of day. So anytime you go that's not a Sunday, that is now business mileage, but the mileage that's traveled on Sundays would be considered commuting. And so when you're saving your gas receipts and doing all of that, and another thing to note is that, you know, gas receipts are just the beginning. You know, of course, your oil changes, that's a no-brainer, your tires, anything that has to do with that vehicle. If you got to turn around and get it painted, you know, that's still a vehicle expense, but it's only reduced by the amount of business usage, the percentage. So if you drive 10,000 miles and 5,000 of it is commuting, and that's the only vehicle you use for business, only 5,000 will take that deduction. 5,000 of those miles will qualify you for the deduction. So pretty much you'll get to write off 50% of your insurance, your gas, and all of that. So there's two ways to look at it. To go just a little bit deeper, you have what's called your actual and what's called your standard. Your actual is what's leveraged against the business percentage. Your standard is where you just put in, I drove 20,000 business miles, and they're going to give you 58 cents or whatever they adjust it every year, 58 cents per mile. And a lot of times that's an easier route to go, and you actually get more money, because where if you're driving a lot, doing a lot of traveling in your vehicle, you may have a situation where your standard deduction is $10,000, but you only spent $5,000 in gas, insurance, and maintenance. So, you know, you have to leverage that. A quick rule of thumb that I would say is, if your business doesn't require you to drive a lot, but say you buy a new vehicle, go actual and take your depreciation on that vehicle, because that depreciation, you can take as much as you want up front, and that can really help a tax return.
Okay, explain that part though, because a lot of people may not know what that means, like, you know, depreciation and stuff like that. Kind of explain what that is.
Okay, so depreciation is what you have on any type of business property. So you can depreciate your computer, you know, you can depreciate your keyboard. If you're in the real estate, you can depreciate your rental property. So basically they say the lifespan of this item, you know, in a car is usually 5 years. We can, when they say depreciate, we can calculate the wear and tear. You know how they say when you drive off the lot, it loses value? Right. So depreciation is the declining value of that asset. And so they also base that off of the usage. But they have what's called bonus depreciation. And then they have what you might see in that tax return, a 179 expense. And that's basically where you can say, I'm gonna go ahead and instead of spreading this depreciation write-off over the next 5 years or the life of the asset, I'm gonna take it all right now, you know. And so depending on your situation, that can be very helpful. Okay.
Man, I gotta ask you this, man. I gotta ask you this. What made you interested in doing taxes? Out of all things, like, you was a musician, then DJing, like, what made you say, man, I want to go into taxes and learn this?
Oh man, long story short, about 15 years ago, this guy at a church I was playing for, actually, I was playing keys at the church. He saw something in me, you know, he became my mentor, and you know, he invested in me. He actually helped me get my full-blown DJ career started. But he was like, and he was a tax preparer. He said, man, you're young, you're smart, you can do taxes and you can make some good money. You know, the money you're making all year, you're gonna make that in 3-4 months. And I said, you know, that's okay. You know, my music career is about to take off. You know, I was producing for some artists that I thought were just, you know, so we had that conversation for about 3 years straight. And after that 3rd year of not having the record deal, not blowing up, you know, feeling so close, but yet so far, I said, so about these taxes, you know. So he trained me, and I worked for him for 2 years. By the 3rd year, he fired me. He said, man, you need to go and start your own tax company and build your own legacy. So, you know, that's real. That's Charles Williams, man. Mentor, great friend, and we still rocking together now. Like, we bought the building I'm in, we're buying it together, and it'll be paid off next year. So,
whoa,
you know, it's a good feeling to know that can't nobody kick you out, you know, besides the tax man, you know, the tax collector. But,
right.
Yeah, that's how I got started. Been doing it about 11, 12 years now.
Bro, that's inspiring, bro. I didn't know that. I knew you did taxes. I didn't know you was buying your own building.
Yeah.
That's major, bro. That's major.
Because, you know, and the same guy, he was like, man, you gotta own it. You know, if you don't own it, you're probably not gonna be able to control it. And so, you know, God did the rest. God lined up, you know, the people, the opportunity, and you know, that's really why I got to give the glory. You know, God just really, you know, some of the things that you feel are shortfalls and hangups, a lot of times they're set up for that come up, you know.
Right. Man, congrats to you, man.
Thank you. I appreciate that.
Yes, sir, man. But yeah, as far as these taxes, man, like, so if somebody is trying to get a home, you know, like, they saving the 30%, you know, of everything that they're making, you know, what's the next step as far as, you know, coming to you and trying to get that going? Okay,
so when you come to me, I'm going to ask you some questions about your realtor, what kind of relationship they have with the lender. Some realtors have relationships to where they can tell you down to the dollar, this is how much your tax return needs to say. And then my job is to help you shape your tax return in that fashion. And, you know, there's tricks to it. And the way that my approach to it is to get you to that bottom line and have you owe as little money as possible. And so if you don't have a lender that, or a realtor that can kind of break it down that far for you, my next question is, how much house do you want? You know, if you're looking for a $400,000 house, more than likely, if it's just a single person, they're probably gonna have to show $80,000 of income, you know? And so we kind of do that math and then take a look at what that looks like. Oftentimes, I know not all musicians get paid on 1099s. A lot of it's cash, you know, some of the clubs or whatever, you know, they might pay you cash. We might have to report some of that cash income. You know, you're supposed to, but when you come in and I say, how much cash did you make? Because I had this 1099 here, but how much cash did you make? And you tell me that's what I'm putting in there. But, you know, that's something that you just have to be strategic on. And one approach that some people take is I say report your income. You know, report your income. When it comes to making that move and transitioning into a house, one strategy that I help people implement is to not report all of your expenses. You know, you have the expenses, you know, but if your income is say 90,000 and you have 40,000 of expenses, but we need to show 70,000 of income, we'll just report $20,000 worth of income. You save all those receipts and documents, and it might even be contractor labor. Go ahead and issue your 1099s or whatever you got to do for your contract labor. And after you get in your house, we'll come back and amend the return and add on that other $20,000, which effectively lowers your tax liability and gets you some of that money back. So you're not taking the complete L. So that's the way I would rather do it. I'd rather leave expenses off than add income on, because it's, you know, it's taxable income. You're going to have some tax liability if you do. Right. Okay. That's good to know, man. You dropping gems. I'm trying. Yes, sir. Trying. So tell me this. People talk about this all the time. LLC or corporation. As far as for a creative, which one would you think is best? I know it's kind of based on the individual, but if you had to choose, would you say LLC or corporation? Which one would you choose? Well, corporation, when we use that term and we talk about S Corp and C Corp, they're a designation. So as a LLC, you can opt to be designated as an S Corp. There's a form that you fill out at the top of the year, or, you know, you have a certain amount of time to send it in and say, hey, I want to be treated as an S Corp, which means now your business, whether it's, you know, an LLC single member or a partnership, can be treated as its own entity, because anything else is just passed through and it's really just you. So my threshold, this is me personally, is around $150,000 to $200,000 of bottom line income. So that means when your expenses are all done and you're showing $150,000, it might be time to do the S Corp designation. Unfortunately, I don't know all of the thresholds and tax brackets off the top of my head, you know, got the internet, but to give an example, which the numbers might be wrong, but at say $100,000 as an individual, you might be taxed at 33%. But when you write off your expenses and you drop down to 50,000, you might get taxed at 20%, you know, just throwing some numbers out there. So basically what a S Corp designation or a corporation designation does for you, it locks you in at a 22% tax rate. And so what that means is if you make $500,000, that $500,000 that you report under that S Corp is taxed at that 22%. It's locked in. And so the strategy at that point will be to designate it as an S Corp, pay yourself just enough money to keep you under that $22,000 threshold so that you're not getting taxed at a higher amount. Pay your employees, you know, get rid of as much money as you can to keep everybody under that threshold. That way the remaining income that the company reports is taxed at a lower rate.
Nice.
I hope that makes sense. The way I
yeah. It makes sense. Make a lot of sense. Now I want to ask you this. Say if it's a musician that's getting royalty checks. Okay. How does that work?
Royalties are what they are. You know what I mean? It's what's called unearned income, you know, or passive income. And so unfortunately with royalties, even though it comes on a 1099 miscellaneous under the royalty box, we can't really write off any expenses because it's work that we've already completed and, you know, and it's done. So with your royalty checks, it just is what it is. But as a working musician, you know, you can still say if you're paying for studio time, you know, or you have a home studio and you don't make one dime outside of what that royalty check is, you can still create a Schedule C, you know, a business form, and write off the expense of that business area, or if you're going out paying for studio time, or if you're hiring musicians. So even if you don't make a dime, but you have income on the royalty side, it's not going to look so crazy when you say, I spent, you know, $15,000, but I didn't make anything except for that check that came in. Hopefully the work I did this year will yield some checks in the future, but that would be the strategy I would do. I never really got a huge royalty check, but for those of you who have a lot of money coming in, that can be an approach to offset some of that taxable income.
Right. Okay. Man, bro, you own it. Now here's another question for, say, an artist. So you're an artist and you have work for hire musicians. How do you make sure that you're in line with your taxes as an artist that's paying work for hire musicians?
Okay, there's a form called a W-9, and you have to have any contractor that you pay to perform that service, have them sign out that W-9. The tax law states that anybody you pay $600 or more, you're supposed to issue them a 1099. So when they fill out that W-9 at the end of the year, and of course we have to file them by the end of January, you turn around and create a 1099 and issue it, you know, and that's something that if any of, you know, your viewers or listeners need help with, I can definitely help them. And I do those 1099 filings for those who don't know how.
Right. Okay. So for the people that don't know, how could we find you?
Okay. Facebook. No, the website is tax2go.com. And that's kind of the umbrella website, and I'm on there. I can be reached that way. My email address is Jacovie, and that's JACOV as in Victor IE at tax2go.com. TAX2go.com. And I'll answer any email as promptly and as thoroughly as I can. I think that would be the best way to reach me.
Man. But I definitely appreciate you coming on, bro. Spending a little time with me and knocking it out the park with these tax questions, man. Because I think taxes is a game that a lot of people don't know how to play.
That's right. You gotta learn how to play the game. That's right.
Yes, sir, man. Well, again, bro, I appreciate you coming on, and we'll catch up for sure.
All right, thank you for having me, man. Take care.
Sir.